Hello, you two. It's so nice to see you again, Matt. And Taylor, this is your first time as my victim.
Yes, it is, Rebecca. Thank you so much for having me.
Oh, it's lovely to have you here. And how are you, Matt? You all right?
I'm really good, thank you. It's good to be back.
Yeah, well, it was good to see you and actually meet you in flesh for once in Munich.
Yeah,
What's it, 3 weeks ago now? So,
in a
yeah,
Bavarian beer hall.
yeah,
Was it
yeah.
Oktoberfest? I mean, I guess it was November, but
Yeah,
you
sadly
guys
not.
there?
Yeah,
Oh,
but we
okay.
we made it almost the Oktoberfest. There was a lot of beer around, and I had my new graduate with me. He's just started, and she sat there with this bit in the beer hall, going, "So this is what grown-ups do."
Right.
It was very funny. She thoroughly enjoyed herself. Anyway, we should get to the topic here. So we're going to talk about private credit today, which I'm really interested to hear about myself. So Taylor, well, what constitutes private credit? So that everybody understands. And I know you said to me before that it's grown dramatically since 2008. Can you explain sort of what's changed, what it is, what's changed, and tell us all about it?
That's right, Rebecca. Absolutely. Happy to do it. It's become an asset class that's been around for a while, but grown in popularity, really. I mean, none of the products that they're offering are new. It's more an extenuation of private equity shifting up in the balance sheet and the capital structure to lend directly to companies instead of investing in traditional private equity terms with companies, right? So that gets them much more protections on the downside and with rising interest rates, better return for offering debt. So as interest rates came up in the last few years, you could get 10, 12, even 15% returns by extending debt when you were investing in a company and getting 15 to 20%. Plus, you get all the protections of a lender, and so it became much, much more attractive, and many private equity funds began raising large private credit funds.
So yeah, so there's quite a lot been going on. So Matt, tell us about sort of recent developments, and maybe you could give us some examples and talk through what's happening with things like First Brands and Tricolor. It'd be interested to sort of find out why the market's paying attention to this.
Yeah, it's an interesting one, and it seems to be getting a lot of headlines in the financial press. It's mainly because people are currently looking at what could go wrong next, I think. And it seems that private credit is relatively opaque compared to regulated banking. Private credit estimates are around about $3 trillion now. So it's significant growth since 2008. And as soon as the financial journalists figure out that they can't get to the bottom of things, then they start to raise questions. And then what added to that was relatively quick succession earlier in the autumn or the fall for our American colleagues was First Brands collapse, which was an auto part maker, and Tricolor, which was I believe, a subprime lender for automobiles. And that section in general, I've always thought is relatively risky. If someone has to repay their debts, the house is the last thing to go. The shiny car on the driveway is the first thing to go. Um, and and it does seem that both First Brands and Tricolor were victims of fraud, that either assets were borrowed against twice, various other financial shenanigans in there. But what that did was it raised concerns over, okay, what is private credit lending against? How is this actually regulated? And how do we stop these issues happening for such a large industry? And then it's the knock on of um, is this systemic issue here if it goes wrong? And the banks actually are involved, but a lot of that is off balance sheet as well. So you could potentially have private credit fronting it, but banks are actually on the hook, or even larger insurers and then subsequently pension funds. It is all a bit scaremongery, but it seems to be the discussions that people are having at the moment. The Bank of England has requested stress testing, which I think some of the largest private credit providers, such as Blackstone, KKR, and Apollo, have signed up to. But I think generally the good ones will be fine. It's what happens if there is fraudulent activity in a company, and also the late to market or the wannabe private credit that don't quite do the due diligence of the bigger ones.
But I think that's exactly right. And part of the issue is capital moves like water. And so when you see a lot of capital going into one asset class, private credit right now. 5 years ago, we would have been talking about SPACs, right? And so you get this boom in deals with a certain asset class that increases the likelihood of doing very risky, aggressive deals where folks can get away with fraud, to Matt's point, because people aren't being as diligent in doing their due diligence into the company, into these deals, because they're chasing yield a lot of times. So that to me is really what we look for in identifying where is the next restructuring cycle coming from. And it does seem that there will be opportunities coming from companies that borrow money from a private credit lender, right?
Yeah, I know that makes a lot of sense. So, I mean, Matt's mentioned Bank of England. What about Wall Street? What's their reaction to all this?
Well, it's exactly the same. So the Fed has been looking at these private credit funds and also private credit lending from traditional banks at JP Morgan. I mean, how does all of this work? How is it going to be disclosed? And is there systemic risk? They're prudently concerned about that. I agree with that. It lacks transparency. The comparison that I gave earlier was when there were all of these companies going public through a de-SPAC transaction, we could pull the materials from the public filings and do research and say, okay, that looks pretty risky, right? So add it to the list, that might be a restructuring opportunity. Now it's very challenging to track all of this. And so then you think about what are the implications of that in reviewing it, and we don't really know, and there's not a mechanism for assessing systemic risk, and so folks are trying to figure that out. So I tend to be a little bit more of a pessimist, having worked in restructuring for over 20 years now, right?
I
Like
think that
people
goes to
call
the
me all the
territory.
time when things are going wrong, right? And my family has to tell me, like, stop being Chicken Little and like calm down, like the world is not going to end tomorrow, right? It's a blessing and a curse to be thinking about the risks out there, but it does serve me well in our business to help our clients in identifying that and addressing it and getting in front of it. So, it will be interesting to see what the Fed does decide to do. And they have published a lot of things online that anyone can go access and read to get insight into what they're thinking about. I mean, there was a recent Harvard publication that's very interesting about this very topic for further reading for anyone that's listening to this. But we need to kind of figure out how to assess this systemic risk, to Matt's point.
Yeah. So, Matt, what about offshore? Because obviously you're sitting in Guernsey. How are offshore funds getting hit by these private credit problems?
Yeah, well, at present, not really, to the best of my knowledge. I think ordinarily most private equity and private credit structures are domiciled offshore. So they'll be managed onshore. They'll be managed in Connecticut, New York, Miami, Houston, London, and then in the major cities of Europe. But their structures will be based offshore. So they'll be in the Cayman Islands, BVI, Bermuda, Guernsey, Jersey. So then they're beholden to the laws of those jurisdictions. And Guernsey in particular is very much a funds jurisdiction. Their legislation is set up in particular to attract funds to set up here, which also gives it a mechanism to assist if things go wrong. Now, what will be interesting is whether it's just going to be the underlying companies, the borrowers, which is probably more Taylor's domain. They either have funders pull out and they have to deal with operational issues and financing issues there. So they're real live issues affecting their employees and their customers. And then from my side, offshore, it's going to be a bit more of the investors who are putting money into these structures. If they have concerns over what's happening to their money, their investments, a lot of the larger houses will have private equity and private credit vehicles. Investors will spread their risk and invest in a number of different vehicles, but they may have concerns over how their money is being lent, what the recoverability of that cash is, what leverage is in there as well. Is this more of a gamble? And to just quickly step back on the opaque nature as well, that defaults with a traditional bank loan, it will be called in, whereas it appears from anecdotal discussions in private credit, they revert to what's payment in kind or PIK notes. So they just roll that interest on top of the debt. So it's not a default, or it's a soft default. So that, and Taylor may have something a bit more on that.
Well, that's something that we track closely, because as we see more, paid in kind or PIK happening, that's a sign for us that something's going on, because you would expect that the company could support the interest based on the projections that they had provided. So something has changed if they're increasing the amount of paid in kind and adding to that leverage at the business. So that is one way that we get insight into where there might be some stress or distress, when we can have that visibility, right? Was that your point, Matt?
Yeah, absolutely. I think that's really the key of what people want to get to the bottom of. And then to come back to offshore, that's where we can assist, is if investors are concerned, or if fund managers or fund of fund managers or trustees are looking at what their clients are investing, and then suddenly there's an uptick in either default rate or weirdly PIK situations, we can do an analysis on that fund to be able to provide investors some independent scrutiny, I suppose, as to how good these loans actually are. And I think banks are now asking for their restrictions to be loosened so that they can compete with private credit. My fear slightly, and I don't, a bit of a doom-monger similar to Taylor, is that we don't want 2008 again. We don't want people who are lending out significant amounts of cash not caring about getting it back. And that's where I think we just need to not necessarily pump the brakes, but have a bit more oversight.
Right. But are you seeing a lot of the limited partners pushing for more transparency with these private credit funds, Matt? Like you talked about having an independent director or having someone actually look at this, because the huge risk to us is that there's no oversight, and they could be marking to market these assets at values that are significantly higher than maybe the public market would assign to them, to avoid defaults or other issues, which would be the warning signs to their investors. And so then everyone's walking around thinking things are nice and rosy, when in fact there are issues to address. And in our business, we see all the time, well, if you had called us 6 months ago, we could have possibly gotten in front of this, and here we are, and we need to potentially file for bankruptcy tomorrow, or if someone can't make payroll, or have all of these issues. And so that's where the rub is, to have the appropriate kind of check and balance to address problems when they come up, which naturally they will, but not avoid them or kind of brush them under the rug until you're such a challenge to address that you have limited options per se, right?
Yeah, and I think we're going to see more of it. Typically, a fund structure doesn't tend to have debt in it, so it's only the investor's capital that's at risk. But significant investors, I think, in the new year are going to start asking for independent directors or for health checks in relation to those funds. And it's only then that we'll start to see actually how big the risk is and what the issues are. Because at the moment, with any private institution, as you alluded to, they're marking their own homework when it comes to the recoverability of this. Similar to, whilst there are accounting principles at play, there's a lot of nuance, and it's open to manipulation as well.
So Taylor, let's get on to restructuring options themselves. What restructuring options does the US Bankruptcy Code provide you with?
Well, specifically, the Bankruptcy Code has Chapter 11, right, which I think many people become very familiar with now over the last 20 years because we've gone through several cycles, principally the financial crisis coming out of 2008. And we saw a huge boom in providing support services to help companies and their management teams navigate a Chapter 11 process in the US, which has a lot of benefits to debtors, companies that file for bankruptcy. But what's interesting with private credit is there are other alternatives that might be more affordable to Chapter 11 that folks are exploring now, such as, Article 9 process, which is under certain state laws, and, an out-of-court process to bring in a CRO or chief restructuring officer, or a new management team, or an independent board director, and get in front of these issues so you can avoid Chapter 11, because Chapter 11 has become a very expensive restructuring process. So what's interesting to me is to see how we work with these private credit funds and the companies borrowing their money to explore different avenues along those lines to avoid a Chapter 11 or go down that path if necessary, but ultimately to preserve value and options and make the business better and stronger coming out, right? Because that's the ultimate goal. So, Chapter 11 is the very popular approach. Folks are very familiar with it, but there are a lot of other tools in the toolbox, per se, that we can use to help our clients save money and avoid Chapter 11 even. So, we could spend a whole podcast talking about each one of those to educate folks, and then if they're not familiar with it, but certainly welcome the follow-up to discuss in detail, because it's absolutely something we're talking to folks about. The head of our restructuring practice, Eric Danner, just gave a presentation on that to the Turnaround Management Association at our annual conference in New Orleans 6 weeks or so ago. But there's a lot of alternatives in the US to explore. I don't know what there is more internationally, but would certainly like to hear more about that from Matt, what you're seeing on your end when folks are coming to you.
So Matt, tell us about what you're using offshore.
The offshore process in most of the British protectorates would be akin to the UK process. Administration is probably the most similar to a Chapter 11, although there's normally an independent party engaged to oversee it, as opposed to what is quite alien to us as debtor in possession. Because I would say, if you've screwed it up, why do you get to continue and try and fix it? And then there's the end of life scenarios of liquidations, where that would probably be closer to a Chapter 7 in the Bankruptcy Code. The key to these things, I think, is the cross-border cooperation. Chapter 15 is hugely helpful to us in the offshore world, especially when you have any kind of US connection. That allows everything to be coordinated. I think looking back from 2008, there were problems that were cross-border and they were dealt with in each jurisdiction that racked up costs, that had office holders fighting against each other to try and make recoveries, or they purported to try and make recoveries for creditors and investors. So I'm hoping that that cooperation is going to be smoother this time around. I think the judiciary in various places, they tend to speak about these topics frequently. And that, I think, is going to be the measure of how many can be fixed versus how many end up in an end-of-life scenario.
So have you learned particularly from certain cases that you've seen or dealt with that you could perhaps give us as examples and what you've seen?
Yeah, I mean, I worked on quite a lot of the Bernard Madoff stuff. I dealt with the Icelandic banks in 2008 and also MF Global. Um, the cross-border assistance, I think getting on with the relevant parties in the relevant jurisdictions is huge. The amount of egos that I've seen at a more senior level than me at the time, which just completely unnecessarily racked up fees. Selecting the right lawyers as well, I think, is something that's underestimated in a time of panic, because people will make incorrect decisions, and they'll never be the best option. It's always the least worst option. But being able to get on with the people you're working with cross-border globally is really going to help stakeholders.
I can imagine. And Taylor, is there any examples that you've really learned from?
Oh, the M&G Chemical was quite an experience when I was with Alvarez and Marsal. I was a Chapter 11 bankruptcy in the US, but there was a process in Luxembourg, a process in Italy, a process in Brazil, very global restructuring that had an incredible outcome with given the circumstances to ultimately sell those assets. And Matt made a very good point of why does the debtor in possession continue with this? And that is a great example of why Chapter 11 is so popular, because in many instances with those problems, you don't have another team or a set of folks that know the business that can parachute into that situation quickly to run it and then ultimately liquidate assets if necessary. And so that's the real incentive why this process of Chapter 11 works. And ultimately, many international companies lead with that as the key restructuring tool and attach on the other jurisdictions to that through Chapter 11. Or rely on a Chapter 15 as Matt mentioned, if they have an office in the US, but most of their operations internationally, right? So, given the fact that it does afford so many protections to the debtor in that regard, we're able to restructure companies quickly and efficiently, whereas in some other jurisdictions, it can take much, much more time. And the management team and everyone leaves. And so, trying to figure out what do we do here when you don't have anyone that actually caused the problems, which is the flip side to Matt's point, right, can prolong the process. Now, I tend to agree that if you're using Chapter 11 as a tool just to try to, clean your balance sheet sometimes and hide the mistakes that you made and even profit from that, and then you continue on and then make those same mistakes, like, yeah, I mean, we can, have cocktails about that all night as to how that's not right. And that's the risk with it, right? But in that regard with M&G, I mean, we were facing a chemical plant that was going to melt down in West Virginia. And if those employees had left, we would have had an environmental crisis. And we were able to navigate through that, right? So there are certain things that go all the way back, in the history of the US that are particularly attractive about that. There's a whole lot of other stuff going on in the US that makes no sense right now that I'm sure people internationally are wondering what's going on, but that one still does. And that is a great example of where, had folks left, we, even with all the experience with the best people in the business, at Alvarez or, CohnReznick or whatever firm, would have really struggled. And the folks operating that plan and working at the company really came together to help through that. So I think that is the best example I could think of as to why it really works.
Oh, it's a really interesting case studies, actually. I could talk to you for a long time about those.
Oh
It's
yeah, we could.
fascinating. Well, from both of you, it's the range of stuff that you get involved in this work is amazing. So, I mean, you fairly well sort of stated, I mean, anybody listening to this can see where you can be of advantage. But let me ask the question. So how can Nexia TRI really help investors and companies and fund managers sort of navigate their way through these things? So, Matt, what would you say?
I think Taylor alluded to it actually with his case study, is that Nexia's got global coverage, and it needs to be people that you trust, that you know are sensible, that are going to do the right thing. If the US is where the dictation is coming from, then you want Italy, you want Denmark, or whichever country to play as part of a wider team. I think some of the larger brand firms are the same as Nexia in that they're franchise operations. But what I really like about Nexia TRI is many of us are personal friends. We've worked together for a long time, and we know that we can pick up the phone to each other, and we know we can get the best service very quickly. And I've worked with CohnReznick quite a lot with Cayman Island stuff that has US assets, and it's been really helpful. There's nothing worse than whether you're a Nexia member firm and you're trying to win a piece of business. Nexia TRI is great because you know you've got trusted people in that list of contacts, and then working with them as well. There's nothing worse than working 16, 17 hours a day and not getting on with the people you're dealing with, or they don't want to listen to you, or they're not going to help, or they'll be obstructive. So I think that's the value Nexia can bring, certainly from my perspective.
What about you?
That's absolutely right. And bringing everyone together. I mean, who's out there? Just given the nature of the business, when things go wrong, they tend to go wrong pretty quickly. And so who do you need to get in touch with the right skill set to come together quickly to resolve the problem? And Nexia provides that information with connecting everyone to easily do that and identify who's going to be the right folks to work with. To Matt's point.
Taylor, Matt, it's been fantastic seeing you today, and I've really enjoyed this podcast. It's been really informative, so thank you, and I hope you have a good rest of the day.
Great.
Thank you so much.
Thanks a lot.